Hello, my name is Aaron Edwards, co-founder and market consultant of Santos Springs. We offer grain marketing solutions to producers in multiple countries. Welcome to our W2H grain marketing channel. Go ahead and hit the subscribe button. I also recommend tapping the bell so you get future notifications. And if you like what you see, hit the like and share this video with other farmers who care deeply about their grain marketing. If you are a corn or soybean farmer, your revenue depends not only on your production, but also the answer to three simple questions: when, how much, and how you sell. One W, when, two H's, how and how much. Our W2H mentorship provides a clear, concise, and custom approach to answering each one of these three questions for your specific farm throughout the year. Before we start this week's content, it's always important to remember that trading in futures products entails significant risk of loss, which must be understood prior to trading and may not be appropriate for all investors. This commentary and the information contained within should be considered market commentary and reflect the opinions of the author. For those of you watching this with a delay, if you are a U.S. corn or soybean farmer and want to stop being held hostage by market uncertainty, let us teach you how to place each one of your bushels in a grain marketing strategy specifically designed to optimize your farm's revenue. Click on the link and we'll work together to see if our W2H mentorship is the right next step for your grain marketing.
This is Aaron Edwards with Santos Springs, January 20th, 2026. Markets closed yesterday. So we had the report, not yesterday, but last Monday. And then we had a bad week of trade. It stopped bleeding out. Looks like maybe we're getting some footing. Really, we're going to see the direction of the market a little bit more this week. Is it going to continue to roll over and sell off, or are we going to finally get the market to stop? Before we get into too deep of market analysis, I want to, just like we always do, that bias towards action. So let me go ahead and share my screen. We're going to start with this week's recommendations. So we're going to focus, let me grab a highlighter here. Let's do green. Okay, so we're focusing, first of all, we're focusing on our Q1 2026 corn bushels. And what we're going to do is we're going to lock in the basis on 30% of them. I went back and forth on this, and if you've been following along, you know that we have some basis contracts on corn, and so we've been moving corn on basis contracts as we need to move corn. So why would we do that right now? We don't really need to move corn necessarily, but here's the thought, right? For our Q1, we've got one more week in January, roughly, then February is a short month, and then we have all of March. So by the end of January, we're a third price on basis. We're just keeping on pace. And I actually think we might extend those basis positions even more next week or beginning of February. We might even get more of that work done. So basically, this recommendation is just to keep us on pace with moving corn. But it does make sense from a risk management standpoint. So I want to back into that. We're going to spend most of our time today talking about corn, but let's brush over the soybeans first. And if you follow along, if you're familiar with what we do, this pyramid is in every video because we really want to hit it home. It's a plan, a market plan portfolio based on your operation, what needs to happen on your farm. Then on top of that, we look at the market through the lens of seasonality, the position of the spec funds, and technicals, and that gives us our call to action. So what does the farm need? What's the market telling us? And then how do we act? That's how our philosophy of handling grain markets is rolled out. So just review for those who watch often and make sure we have that. So in the middle of that pyramid, we go over analysis. So we're going to start with soybeans. This is the position of the funds. Speculators in Chicago, they can buy or sell corn and soybeans when this number is at 0. That means that the total long and the total short positions basically are a wash. They are as long as they are short. When this is below 0 in red, like down here, that means the speculators are net short. They're sold in the market. And then when we have what we had in November, when we got that rally up in soybeans, speculators are net long. Then there's thresholds beyond that where if they're oversold or overbought, we want to react. It's very clear what happened. We started seeing soybeans rally, and then they rallied up to the peak in November. Then they started selling off in December. The good news is speculators are still long soybeans. Even after the report, even after everything, we still have it's very small position, but we still have speculators long. That is the good news. The bad news is if they do choose to keep selling this, we could get additional downside pressure on soybeans, and it's going to make a lot of sense when we look at the actual trade on soybeans. So this is the futures contract. This is March soybeans, and I'm going to go ahead and grab blue. Here's the 20-day moving average. I'll track it up and then down. This is the 20-day moving average. And this is the 200-day moving average. So the bad news is we got this right here. When the 20-day crosses the 200-day, that's known as a death cross. And technically, it's very bearish. It would point towards lower prices. To make matters worse from a technical standpoint, I'm going to circle this and then I'm going to zoom in on it. See if we can zoom in on that. Friday, we closed out our trade. If we can see where we're at, there we go. Friday closed out its trade right there, tapping the blue line. They're at 10. See, the green line closed at 10.57 3/4, and the blue, the 20-day moving average coming down was at 10.58 1/4. So it tapped that 20-day moving average and failed on Friday's trade. It would be very, very nice from a technical standpoint if we could get any degree of recovery in here, any amount of recovery in that. If you're watching the soybean market, the March contract, if we could get 1060 anything, right? 1061, 1062, 1065, whatever it is. If we could trade in this area over the next week, technically speaking, that would be very helpful. What would be a fairly normal pattern and a very disheartening pattern is for this 20-day moving average to continue capping this market on the downside. And then we see the soybeans, even if they try to rally, they just work their way down and down, and it's just a nightmare. That would be the bad news, right? So that's not what we want. So technically speaking, soybeans, they're right there at that point where if we could just get up over the 20-day moving average, we don't even need to rally. If we can just stop the bleeding and get position, technically speaking, hopefully that would be enough to kind of stop the sell-off of the speculators, where they're like, oh, it looks like beans don't really want to sell off, and at least give them pause so that we can just calm down speculative selling on soybeans. Next, we want to talk about corn, and we're going to spend most of our time today talking about corn. I'm not going to go over a ton of the bullish or bearish fundamentals, I should say, but we do want to cover the corn market. Let me share it here and let me grab a marker. Let's see what color would work here. I think green will look good here. Let's see if it shows. Yeah, that should show up well. So the big thing, speculators, we had it's been almost a year ago now, but we had speculators excited about corn last February, and then they sold off, and then they got neutral here right around planting time, and then they absolutely sold off. And we really had an extended amount of time here where speculators were just punishing markets. That was just a mess. We all lived through that, and it was a horrible time. If you remember, we finally got the position updated, and I think it was these 8 weeks. If I selected 8 weeks in that, let's see, 1, 2, 3, 4, 5, 6, 7. Oh, I got 9. But basically, if you look, I'll do it in green and red, whether they were net long or net short. So long, 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 and then short, 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 short. You could tell that the spec funds were just teetering. Should I be long? Should I be short? Should I be long? Should I be short? Then unfortunately, we got the USDA report on last Monday, and man, did they answer that question. Just absolutely obliterated the corn market with a huge downward move. If they keep selling off and we get under this 100,000 contract mark, we'll start thinking about they would be oversold, right? That's an indicator where we say, okay, it's overdone. This is oversold. Now they can stay oversold a long time, and I'm not trying to be the bearer of bad news, right? They can stay oversold a while, but we would check that box that they're oversold. So yes, speculators sold aggressively, almost oversold. The bad news is they can stay in that position a long time. So is that what will happen? And here, this is interesting for me. 2 things that I wanted to point out. Let's see if we can do black here. I don't hardly ever talk about this down here, but this is volume, or I guess it's open interest, but it's a proxy for how many contracts are trading hand. So that's a good way for you to think about that number. So this nasty bar, this is Monday's session. And then what was even more disheartening was, to some extent, was Tuesday's session, where after we fell all day, we kept falling. And that was a very disheartening move. Having said that, I'm going to back that up. I'm going to zoom in on that, kind of like we did on soybeans, because it is interesting to me. All right, now let's zoom in on that. When we look at this move downward, that should do it. So we got that huge bar down coming off the report, and then we got one more bad session with Tuesday, and it was very disheartening. Since that low on Tuesday, a couple of things have happened. Let me see if I can get this one in black. I'll see if I can zoom in a little bit more. First of all, since Tuesday's low, we have had progressively higher lows, with Wednesday being higher than Tuesday, Thursday being higher than Wednesday, and Friday being pretty much where Wednesday was. The good thing about Friday was we had a higher high than Wednesday. So it's not hopeless from a technical standpoint. The concern is it's really a coin toss once markets open up. Will we get another sell-off down? Let me get this a little thicker. Will we get another sell-off where, yeah, it was just catching its breath a few sessions, and then it's going to sell off again? But then we have to remind ourselves of kind of where we're at. This was the harvest low. So will we go back down to the harvest low? We could, that we would be losing about 15 cents more, which is bad. But is it going to go under the harvest low? And that's where perspective comes in. Even when we had massive net short positions, those net short positions, remember, speculators started aggressively selling it here in May. Those huge sales, that took us, that's what that huge selling pressure did last time. So could it happen again? It could, but we've already sold a lot. And are we going to have at what point in time is it just cheap enough? Is corn just cheap enough? Do farmers say, I can't deal with this? So the reason that we're not going now let me talk about basis and I'll summarize it a little bit. So this is just basic information. Now we're going to look at two basis charts. The first one is the one that I use as a reference. We use the Purdue basis tool. They have a nice basis tool just as a proxy to explain the concepts. A lot of times I use this. So this is Tippecanoe County, Indiana. And it tells a lot of the story of basis. We're going to look at this just because it's the default. It's basically the default that shows up when you use this tool. And then we're going to go look at Northwest Iowa because the Western Corn Belt basis is performing differently to some extent. So the recommendation was to lock in basis. What's the thought process behind locking in basis? This big bump here is basically that's a contract shift. You could tell it's just a lot of the December basis come off at the end of November. So this is basically a switch from basis contracts to March basis contracts. That's a big part of that bump. But you could tell if we just think of the black line being this year, look at the recovery from the harvest low up to this point. And then also, if we look at the historic averages, that recovery is normal after harvest. We have bad basis at harvest. Then it typically recovers. And then it somewhat stays sideways until spring. So the recommendation is on the quarter one basis. So we kind of have to look at this period, right? That's basically the period we're looking at. During this period that we're looking at, what's probably going to happen to basis? It'll go up and down and maybe slightly up. That's probably what's going to happen. So getting started on locking in basis when we had a bearish report, it gives us some cash flow, it makes sense. Is it going to be the best basis of the year? Probably not, but with the fundamental situation, there is also a possibility that, let's say, corn rallies and this basis comes down a little bit, even if later it's going to recover. So it might give us a little bit of that if it even goes that high. So for me, it's just locking in basis here. It's one of the better opportunities that we've had since, if you look at the March contract, it's one of the better opportunities that we've had since harvest. It allows to move cash flow. If we were to rally in the corn market, which is ultimately what we want, but as bearish of a situation as there is on the fundamentals, if we were to rally, that basis could pull back. So I wouldn't go all in on basis, but some people have cash commitments for January or first part of February. So you have to generate cash this week, next week, and the next 2 weeks. It's a solid step forward, and a lot of what we do is just spacing out our strategies so that they make sense. So it's not an aggressive strategy by any stretch of the imagination, but it is a solid step forward on our quarter one bushels. Now we're shifting gears. This is the Northwest Iowa, and you could tell it's just a different situation. I'm even going to grab this if I can in red. I think it'll make more sense. So what's tough is, historically speaking, we have that same recovery that we mentioned from harvest to that, and then we have a sideways basis. And then maybe we get a little bit of excitement in the spring, and then maybe a little excitement in the summer, although there's also some volatility that opens up. That's just normal. That's just the normal pattern. What's so tough is at harvest, basis in the Western Corn Belt was already about 20 cents. I mean, I'm looking at Northwest Iowa, right? In some regions, it was worse. So it was already, in a lot of places, probably 20 to 30 cents worse than it usually is. That's huge. And then it hasn't really recovered very much. It's recovered a little bit, but between the harvest low and the current basis, there's less than 10 cents. It's depending on where you're at, it's about 5 or 10 cents in a lot of those areas. That's just a tough situation. So I went back and forth. Is it still the right thing to do? And I landed on yes. Even in the Western Corn Belt, it does give you cash flow. Also, look at just look at what typically happens on basis in the Western Corn Belt. So we're going to go January, February, March. That trimester, that quarter, right? We're looking quarter one. During that period, historically, on average, we don't have significant recoveries. Hopefully this recovers and gets back up to those levels. That would be wonderful. But if it's going to chop sideways like it has so far, we actually could see that basis come back down. So again, we're not betting the farm on this strategy, but it's a solid step forward. It moves some corn, locks in some basis on some bushels if you need. You have some January commitments, some February commitments. It's not going all out. It's a third of your quarter one bushels, and we're locking in the basis. Typically, that gives you a little cash. It's just a small step forward. Now let's look at let's just summarize where we're at on everything. So as we look at kind of the logic or the summary behind the recommendation, seasonally, it is neither a buy nor a sell for corn. For soybeans, it is a sell because of the South American growing season. Managed money, the reports are up to date. That's the good news. The speculators are short in the corn market, slightly long in the soybean market, but neither one of those are big enough to be either overbought or oversold, so it's neutral. The trend on corn is down, and the trend on soybeans is down. Basis levels are above historic averages in the Eastern Corn Belt and below historic averages in the Western Corn Belt. In neither market do they seem very volatile, but given the fundamental report from last week, if futures were to rally, we could see further pressure on basis. Also, at this time of the year, for cash flow and logistical reasons, corn needs to be moved on many operations. So locking in part of the basis as we move along makes sense. The soybean market experienced a death cross and rallied back up to the 20-day moving average on Friday, but could not close above it. Technically speaking, this is bearish. And may signal a longer sell-off. If we can hold our ground in the soybean market this week, for example, trade within the 1060s level on the March contract, that is potentially very good news technically for soybeans. And it could stop more selling pressure from speculators. Corn fell like a ton of bricks after last USDA report. And after new lows on Tuesday, we have seen slight recovery to close out last week. It is also very important that corn holds its ground. And then we have a question which may have already been answered just by the recommendation, but I will go over it. Should I use basis contracts to lock in bushels that need to be moved by the end of January? So this customer, for the sake of cash flow, he has commitments. So he has to move a certain number of bushels just for cash flow and logistics. It just makes sense. Late January, late February, which I think is the case with a lot of operations. Should I move those bushels on a basis contract? And the short answer is yes. The 30% is the recommendation, assuming bushels can be stored through the end of March. So case by case, maybe you want to be a little bit more aggressively, but that is a strategy that makes sense. And then the follow-up to that is what contract to use. We moved some quarter 4 bushels using either the March or the May, depending on the spread. And a lot of people have a mix of both. So for a couple of reasons. One of them is the sake of just distributing risk across multiple contracts. But the other one is to give ourselves through planting season in case we get a spring recovery, because winter rally is, as winter clips by and corn is pressured, it's disheartening. I would recommend not using March because we've already used some March, so just spreading that out. I would do May and July and how to pick between those two. That current spread is about 12 cents. So if the difference in basis between those two is more than 12 cents, you can lean May. If it's close to 12 cents, I would probably put some in May, and I would probably lean on July as well. I really like, essentially by writing a basis contract, it's almost as if you were long the July contract, or you're hoping the July contract rallies. I really like being long the July contract just in general, for both corn and soybeans, because it gives us through, it gives us basically, gets you, that famous 4th of July, sell by the 4th of July. So a lot of these basis contracts are done at the end of June, but it gives you a lot of, any delayed planting, any hiccups at the beginning of the crop season. We have quarterly stocks at the end of June that can add some volatility. So that June month, a lot of times it gives us some interesting opportunities. That doesn't mean they're good, but having the extra time and being able to navigate that May and June volatility, I do like that July contract a lot. So, punch the numbers, get the quotes on both, especially if you already have March. I would try to space more out into May, and I would try to get at least some in July. The truth of the matter is we don't know if we're going to get a rally, when we're going to get a rally, and how well it's going to perform. We don't know that. But historically speaking, having exposure to the upside coming into the spring, this wasn't so much the case last year, but most years that is absolutely the right thing to do. So it's one of those decisions that you just have the odds in your favor. So unless the basis is very punitive, as long as it's close to a 12-cent difference, that July contract can be pretty interesting. But May or July, they're both, I would use either one of those. And I absolutely think it's a good way, either logistically or cash flow, if you need to move some bushels. That's a great way to, postpone that decision, solve some challenges pragmatically, and I don't want to lock in this price. I don't think that makes sense. So the question of the video was, is it time to buy? And my thought is, I would not just, probably case by case, there might be some opportunities, but I probably wouldn't just say, I'm just going to go buy this because it's going to rally. It might rally, but case by case, maybe look at it. If you have questions, feel free to reach out. But I do think that writing a basis contract is a smart way to keep exposure in the futures, but capitalize on the relative strength of the basis, or just the firmness of the basis, and it's a way to stay long, so to speak. And I like that strategy. Hope you have a great rest of your day, great rest of your week. And man, we could use some higher corn prices and bean prices, but let's hope that we don't have another red week for the rest of this week. Have a great rest of your week.